Hi, I'm Colin Williams. I'm here at the Global Derivatives Conference 2016 with Svetlana Borovkova from Amsterdam. And Svetlana, you've been saying for a while now that negative interest rates in Europe are likely to be here for a while. Do you think the European banks' payment and trading systems were ready to deal with negative interest rates?
We work with several banks in the Netherlands and in Europe, and we see a whole range of readiness. Some banks are or were ready in time, while other banks, and pretty big ones, weren't ready at all and had massive difficulties, ranging from simply invoicing their clients on deposits, which suddenly had to pay because of the negative rates, to their derivative systems that, of course, all relied on positive rates. So the degree of readiness was in no way correlated with the size or sophistication of banks, surprisingly.
Right. So would you say there are any other unexpected consequences of negative interest rates?
Actually, it's surprising how wide the range of unexpected consequences is. Yeah. Well, first of all, maybe you've heard about the big court case in Switzerland, where mortgage holders suddenly had to receive interest rates rather than pay them. Because their mortgage rates was only maybe 50 basis points above Swiss LIBOR. And so having a mortgage was actually a profitable business for them. In fact, they won the court case.
Right.
And in the domain of, let's say, trading models, derivatives, consequences could be also very interesting and unexpected, ranging from, again, very basic fundamental things that we learn at school. For example, put-call parity is suddenly completely different between puts and calls. And another thing is that we all know, it's Quant Finance 101, that American call should never be exercised early, but American puts should. And of course, in the negative rate regime, it's the other way around.
Yeah.
So now suddenly American calls should be exercised earlier, but not American puts.
That's very interesting.
And finally, another interesting consequence that we saw is that quite few deals, collateralized deals, for example, where there is some sort of collateral interest payments, had floors at zero interest rates in them by clever banks that put them there even before rates were very low or even negative. And obviously these floors can be seen as options. And these options, when they were put in the contracts, were deeply out of the money, so nobody even thought of them in any way. And suddenly they are very much in the money. So the counterparties want to get out of those options, and so they have to buy them off.
Right.
But nobody has any idea how much they're worth or how should they be valued.
Very interesting, yes.
Yeah.
So people have been using a simple displacement factor to deal with negative interest rates. Why would you say that's very popular?
Well, we love exponential models, log normal models, because we can use Black-Scholes theory under those assumptions. And it's very difficult to go away from them. And displacement models, they provide you a way of staying within the domain of these exponential models simply by shifting your entire space into the negative territory by some displacement factor, and then swanning on as normal, as log normal, I would say.
So that's a very simple process. Is there a more sophisticated process, you think, for dealing with negative interest rates?
Well, you see, this solution of shifted or displacement models is on one hand very simple, but it has a lot of pitfalls. So, for example, the shift with which we have to shift to avoid negative domain is by no means constant. It's changing in time as rates proceed more and more into negative territory. Furthermore, this shift parameter is non-deterministic, it's stochastic, because we do not know how much it's going to get and what is uncertainty surrounding that parameter. So models where this parameter assumed constant is clearly not adequate anymore.
Okay.
And I think that's the largest problem. Once the shift changes, displacement factor changes, you have to reevaluate everything. You have to recompute absolutely everything. So I think the time is right to consider this shift parameter, if you want to stick with those shifted models, as an extra source of uncertainty.
Okay.
And you have to consider this shift parameter as, again, a stochastic process. Clearly that means that it has to be compensated for. So there is a certain price of that shift risk. And this uncertainty associated with this displacement parameter has to be valued in your products.
I see.
Yes, so I think that new realm of stochasticity in this shift parameter is not going to go away. The interest rates might go back into positive territory in a year or two, or we don't know how long it will take. But I think we will never go back to models which do not allow for that shift anymore. But for that, we need to consider shift as being stochastic. We need to evaluate the uncertainty associated with it, and we need to price this uncertainty in the models and in the
Very
products.
interesting. Well, thank you very much, Svetlana, for talking with us. Thank you.